Hello, good morning, everyone. I'd like to welcome everyone to this Making Cash Reserves work event this morning. This is part two of a two-part webinar series. It's great to have so many on the webinar this morning. Great to have so many attending. If anyone has got any technical issues at all throughout the event, please do feel free to contact us using the chat function. We will be having a Q&A session towards the end of the event, so please do feel free to post your questions in the Q&A box as we go through as well, and we'll pick these up and address these at the end of the event. So my name's Carl Taylor, and also on the panel this morning got Jerry Surtees, who is a chartered tax advisor here at Oldfield, spends most of his time advising on strategic tax planning and restructures. Good morning, Jerry.
Morning, Carl. Morning, everyone.
So as mentioned in the part one of the series, this webinar series has been about how to manage the cash that you've generated in your business, to take advantage of the opportunities, and how to protect it from risk and make it work for you. And in part one, we talked about how during the pandemic, during 2020, businesses in the UK have accumulated a lot of cash, and in fact accumulated £900 billion of cash. And on average, our clients' cash levels increased by 243% in 2020. And we highlighted the risks associated with that in part one, and particularly in relation to trading risk and inheritance tax risk. And we also talked about some key principles to help you work out what the right level of cash to hold is in your business. Today, we're going to be talking about how to address those risks that we highlighted in part one. And we're also going to talk about how to take advantage of the opportunities that you have with spare cash. And we're going to look at some tools to help you prioritize those opportunities as well. So I'm going to hand over to Jerry to kick off with talking about addressing the risks of holding cash reserves.
Thanks, Carl. So you'll recall on the last webinar of this series, Jack helpfully went over some of the risks of holding surplus cash. And two of those key ones for me were litigation risk, or trading risk, if you like, and inheritance tax. And Jack helpfully explained that surplus cash, even when held within a trading company or group, may still be exposed to inheritance tax. Even if it's inside your company rather than in a personal bank account, that's still potentially exposed, and therefore is a key risk that needs to be proactively managed. So what we'd like to just talk to you about now for a few minutes is some real practical solutions to these very real potential issues. So firstly, in the connection of litigation, the first thing is that we believe that every business should have, and we know that a lot on the call already do have, a holding company in their structure. And this is something that we touched on in the first webinar of this series. This is a separate, usually limited company which sits on top of you, at the top of your structure, on top of your trading company, and owns the majority or indeed all of the shares of the trading company. And then you as the shareholders sit above the holding company. So you move into the holding company as individuals. If you don't already have a holding company, it is possible to introduce one, but it has to be done in the right way, and it's subject to HMRC clearance. And there's a couple of traps here to avoid for the unwary, if you like, which are, you might say, relatively basic, but they are things that we've seen clients fall foul of in the past. So just thought it was appropriate to flag them. The first thing is that there's a legal process to introducing a holding company. It's not just a case of going away, forming a company and calling it XYZ Holdings Limited, and there you go, there's your holding company. It's the position in your legal structure that's important, not the name. So that's the first thing. And then the second thing leading on from that is that it's important to get we believe to get a law firm involved in drafting the legal documents. And we've seen a few cases in practice where accountants have had a go at trying to draft the documents themselves and save a bit of cost. And in all honesty, accountants are not good at drafting legal documents. So we'd say leave that to the lawyers, and avoid, potentially getting yourself into a bit of a mess. And I guess the real danger with that is that if HMRC were to come along afterwards and try and unpick that, you end up with potentially quite a lot of tax to pay. So it's not really worth the risk. So talking about holding companies, what do holding companies do? Well, there's a number of things that holding companies are useful for, but I guess the key point here is asset protection. So assets, including cash, which of course is the subject of this webinar, can be, once the holding company is in place correctly in your structure, can be moved up into the holding company tax-free, and then they therefore sit there away from the risk of the trading entity, so they're not exposed to claims against the trading entity. And I guess just a couple of tips there in terms of making sure that once you've got that money in the holding company, it is actually safe, and you don't kind of unwittingly expose those assets. The first thing is, don't never sign any commercial contracts in the name of the holding company. So the idea of the holding company is that it's you might say a passive entity. It's not actually carrying out any activities or any trade of any kind. It's just sitting there and holding assets, and that's what keeps them safe. So don't sign any commercial contracts in the name of the holding company, and also don't sign any cross-company or parent company guarantees. We aware that particularly in the construction industry, main contractors and so on have got a bit wise to this, and they want you to sign a parent company guarantee so that if they want to, they can have a go at your holding company, and that really kind of defeats the object of having a holding company, really. So we'd definitely recommend against signing anything like that. In terms of moving the cash up into the holding company, that needs to be done as a legal dividend, and as you can see on the slide here, there's two steps to that. The first is declaring a legal dividend with a board minute and so on, and then making sure that that's obviously signed off and filed, and then actually moving the cash up into the holding company. And both of those things need to happen in order to properly protect the cash. Sometimes we get clients saying, well, I've moved the cash up into the holding company, therefore it's safe. But if it's not accompanied by the legal process, all you're really doing is making a loan to the holding company, which means that asset is still there in the trading company. So it's important to do both of those things to make sure that cash is safe. It's also important to consider timing and amounts. So we say that cash should be moved up into your holding company. Any surplus cash should be moved up into your holding company at least once a year. And the idea of that is to try and make sure that you're moving that surplus cash out the way on a regular basis without showing a big drop in your trading company balance sheet from one year to the next, which, if you did that, could potentially affect your credit rating. So that's just some practical points on protecting your cash from litigation. The second point was in relation to inheritance tax, and whilst a holding company does a good job of protecting your cash from a trading risk perspective, it doesn't necessarily help us, or doesn't help us as far as inheritance tax is concerned. So what are the best ways to guard against that inheritance tax risk in the trading company? Well, there's lots of different options and things that can be done, and we haven't got time on this webinar to cover all of the options. So I've just picked out what for me some of the key ones are. So the first one is pension contributions, and this is a good way, where appropriate and subject to the applicable limits and so on, pension contributions made by the company on behalf of the directors are potentially a good way of securing that cash outside of the company, so it's away from trading risk, but it's also not exposed to litigation, to inheritance tax either, because it's inside a pension fund. And of course, in the process of that, you've also secured a corporation tax deduction for the company as well, at 19% currently, increasing to 25% from next year. So where that's appropriate and where that works, that's a great solution. The second point is finding a job for the cash to do. So where you have got surplus cash balances in your holding company, for example, that you're not expecting or needing to use straight away, but you want to keep them in reserve, the important thing is to think about what your plan is for that cash. And I'm talking in terms of trading plans, or plans for growth, plans for investing in new premises, plans for machinery. All those kind of things are valid trading reasons why you might want to hold surplus cash, and that might be you might be looking 2 or 3 years into the future. And of course, as we all know, plans can change. But the important thing is to have something documented in a board minute or similar, so that that then provides us with quite a significant defence against HMRC coming along and saying this is surplus cash. You can say no, it isn't, because what we had in mind to do with it was this, and you can produce the piece of paper to prove it. The third point is, I've called it succession and spreading ownership. And I guess the point here is that one way of reducing exposure to inheritance tax is simply to spread it around between more people. And particularly in the context of a succession plan, where you're passing shares and wealth down from older generations down to younger generations within a family business, that works quite well in terms of reducing the exposure of the older generation. And in addition to that, something that's not necessarily talked about very much is the impact of minority shareholder discounting. So on the next slide, we've got just a quick illustration of this, and not to delve into all of the detail now as to how this works, but in principle, the important point is that if you reduce your shareholding, that even a relatively small reduction in some cases can have quite a significant impact on the value of your shares in your estate. So the reduction in your shareholding means a faster reduction in the value of your shares. So that's something that's, I think, relevant, and particularly relevant as well where you've got non-trading assets inside a limited company. So you might have a rental property or an investment property, for example, inside a limited company that doesn't necessarily qualify for the usual trading reliefs. And the minority shareholder discounting is a good way of limiting the exposure of the individual shareholders by spreading that around. So that's just 3 points I wanted to cover. Clearly, every situation is different, and what works for you might not necessarily be appropriate for someone else. And we do find that inheritance tax planning is something that tends to be very individual, and there's more to life than just tax. There's commercial and family considerations as well. So what's the right strategy for you will depend on your particular circumstances. So if you think that any of the above could apply to you, please do feel free to reach out. I'll be more than happy to discuss your individual situation. So I'll hand you back to Carl now. I hope that's been helpful. I'll hand you back to Carl now to talk about taking advantage of the opportunities.
Thanks, Jerry. So as mentioned, we're going to move on to looking at taking advantage of the opportunities with spare cash. And there's really 2 parts to this. We're going to cover how to prioritize what we do with the cash, and then we're going to talk about how we actually go about using the cash in the most tax efficient way. But really, there's no question that having a cash generating business and having spare cash reserves, it's a very good place to be. In fact, it's really the hallmark of a successful and a valuable business, is that it's generating cash, and it presents many opportunities, gives you options. The big problem we find in many businesses, many family businesses particularly, is that those different opportunities all tend to conflict with each other, and it can be difficult to get a balance or a sense of priority as to what we do and what we don't do, and in what order we do things. And so really this diagram I've got on the slide now, it's really typical of what we find in many businesses at this stage, where there is some spare cash reserves. We find that there's a conflict between all these different ideas and opportunities. Do we use the cash to invest personally, or do we use it to invest in the business? You can see that those things pulling in the opposite direction. Do we use the cash to reduce debt, or do we use it to invest in things like commercial property or research and development? You can see those things conflict with each other. And so with all these ideas kind of pulling in different directions, it's really a question of, okay, which gets the priority? And in some ways that's really for the shareholders and directors to make the final call, but we can provide some tools, some guidance as to how we see the priorities working in other businesses and from the experience that we have with our clients. So we tend to like to think of priorities using a formula that we've called the LID formula, LIDD. We just find that this helps to kind of prioritize when a big decision comes up. It really helps us to prioritize what we do with the cash and just double check, is what we're doing making sense? Or are there other priorities that we should be looking at using the cash for first? And so, just for example, a director shareholder comes to the table saying that he wants to take out £500,000 of cash for a private house purchase. Well, you need to think about that big decision in the context of LID. So it's just an acronym, and it stands for liquidity first. So firstly, liquidity, then investment for sustainable growth, then debt reduction, and then discretionary business or personal investment. So you need to think about these things in this order. So the first one is liquidity. And that's first because it really is the first priority. Maintaining business liquidity is always the first priority. There's no point in making big investments, personal or business, if it's going to put the liquidity of the business at risk, because it's lack of liquidity that sends businesses under. So there's no point, for example, taking a decision to invest enormous amounts in a new business premises if it ties up so much cash that it ruins the liquidity of the business, sends it bust, because there'll be no business left to occupy the building. So we've got to put maintaining good liquidity within the business first. That's got to be the first priority, and we've got to test anything we do against that first. Then secondly, once we're happy with that, secondly, we can look at investment for sustainable growth. So that's really the next key priority. We've got to look after the business. We've got to make sure we're investing for sustainable and positive future growth. So we need to make sure, in whatever we're doing, we're putting the right levels of cash into things like research and development, software, infrastructure that's going to be needed to actually secure the long-term sustainability of the business, so that it can actually carry on generating profit and it can carry on being a cash generating business going forward. There's no point doing things, no point investing cash in areas which means that this investment for sustainable growth suffers. Third, we've got debt reduction. So once we're sure we're liquid and we're investing in the right things to keep the business going on a sustainable footing for the future, and then we can think about looking at our business and personal debt situation, and we can review whether we can or should reduce our debt levels. And once we've looked at those three key points, then we can be sure that we're in a position that we have spare cash that we can use for discretionary business or personal investment. And this could be, things like investing in or buying another business, could be investing in personal property, investing in commercial property, making pension contributions, building up a pension pot, any of those kind of things. In reality, you probably might do a bit of some or all of these things all at once, but we just find it helps to give context and give a sense of priority when there's a big decision to be made. So, coming back to this director shareholder that's come to the table saying that he wants to draw out 500,000 to move house, it just really helps to go through these priorities. Number one, if we do this, are we going to stay liquid? Secondly, are we investing enough cash into investments for future sustainable growth? And taking this money out, is that going to hamper what we can invest for future growth? And thirdly, do we have excessive debt that we need to look at prioritizing the reduction of? So hopefully that's just a useful formula that you can kind of take away and just keep in your head and keep with you. And when there's a big decision coming up, actually just test it against this formula to make sure we are prioritizing the right things. So once we've got our priorities clear and we know what we want to do with the cash, it's then a question of saying, right, well, what's the most tax efficient way to take advantage of the opportunity? And just, take an example. Say you wanted to invest in another business, you want to buy shares in another business. Well, question, do you take the cash out personally to buy those shares? It's not necessarily tax efficient to do that, because the fact is there's a tax implication of taking money out of a company. Either you've got to sort of declare additional dividends to do that, which isn't necessarily the most tax efficient route, or you've got to find some other route which probably will cost some tax, although if it's looked at properly, that can be reduced. So it's actually best to look at it and, you've got an opportunity, something you want to do with the cash. It's best to see if we can actually take that opportunity through a company structure instead of trying to draw the cash out personally, in view of avoiding the tax implications of extracting cash out of the company personally. Take another example, investing in property. Do we take the cash out personally to do that? Again, it's probably not the most tax efficient thing to do. Best to keep it within a company structure that avoids the need to take the cash out of the company personally. One challenge that I think was touched on in part one was the question of fairness. So we tend to find that when a business gets to this stage, there's quite a number of different shareholders, and they've all got different priorities for what they want to do with their share of the spare cash. Some want to use it for personal needs, others want to invest it in another business, some want to just leave the cash where it is. Well, it's a big question, how do you deal with that? How do you facilitate that tax efficiently and keep everything fair? Well, one solution that we found works quite well in this kind of situation is where we introduce a structure where each of the shareholders has their own personal holding company above the main holding company, where they can make investments and do what they want to do with their share of the excess cash without actually impacting the other shareholders. So, for example, one of the shareholders could invest cash into buying shares in another company through their own personal holding company, and that's tax efficient, doesn't involve taking the money out personally, and it doesn't impact the other shareholders. It kind of ring fences their part of the spare cash. So that's a good way of keeping things fair. Another shareholder might want to just retain their cash in their holding company. Another shareholder might want to actually draw it out. So that's quite a good solution that we see worked quite well in that kind of situation. So, that's the first priority, is to, you've got opportunities you want to take with the spare cash. So the first thing to do is say, right, can we do this through a company structure? If we can't, then it's a question of saying, right, what's the most tax efficient route to draw the money out of the company personally? And I'm just going to run through quite quickly some of the key tax efficient routes for extracting cash out of the company, because we have gone over these in quite a bit of detail in previous events, and most will probably remember them. If you're not sure on any of these, feel free to put a question through or speak to us afterwards. But just briefly, we've got using trusts, particularly things like the welfare trust can be a very good way of extracting cash tax efficiently out of the company, particularly for paying for school fees, supporting grandchildren, next generation, or supporting other situations. Good route. Then we've got commercial property that's currently owned personally. Using that is a very good way of extracting cash tax efficiently. We've got IP, trademarks. So the directors personally realizing their personal investment in developing trademarks. And then we've got pension fund, as Jerry's mentioned, using a self-managed pension funds, good route for extracting cash tax efficiently. Shareholder buyouts, so an older generation sort of releasing their investment in the company tax efficiently. And using your annual tax allowances is quite a simple one, but one that's quite important, one that you don't want to forget. We are approaching the end of the tax year, so remember to use your allowances before the end of the tax year, 5th of April. There's things like the dividend tax rates are actually increasing on the 6th of April. It makes sense to review all of your personal allowances ahead of the tax year end, make sure you're using them. Things like the pension contributions, allowances, capital gains, annual exempt amounts, and so on. Quite important to make sure you're using everything you can in the tax year before they kind of reset in the next tax year. We are actually holding another event like this on the 22nd of February, where we're going to be going into planning for the tax year end in a bit more detail, and we're going to be highlighting key tax planning opportunities to take advantage of ahead of the tax year end. So there'll be a link to book for that coming around on the follow-up email shortly after this event, and that email will also have a recording of this event on it as well, so you can access what we've talked about today. So just to summarize before we move on to questions and answers, just to summarize on the key takeaways, there's actually 6 key takeaways to take away from this webinar series. So just to run through those quickly. First thing to take away is, go away and actually define how much surplus cash you've got. And those sort of benchmarks and principles that we talked about on the first webinar of the series, quite key to go away and use those to define how much surplus cash you've got, and then have a plan to either invest it or protect it. Review your structure, look at whether any changes are needed to facilitate protection from litigation, and protection from inheritance tax, and fairness between the shareholders, as we touched on. Consider succession plan to protect older shareholders from inheritance tax. Use the LID formula, as we talked about, to prioritize the use of cash. Define what the cash requirements then are, and structure things so that things are done in a way that's protected and is tax efficient. And review your personal allowances ahead of the tax year end. Make sure you use them, and as I said, there'll be more on that coming up in the next event. So register for that event if you'd like to hear more on that front. So again, just before we sort of move on to the questions and answers, if anyone wants any help with anything we talked about, these are things that we're talking to clients about all the time. We'd be more than happy to talk to you about your situation. And you can contact us in any of these ways. We've got our personal email addresses up there. Phone number, can contact us through the website. Be more than happy to talk about your situation, any questions that you've got. So want to move on to questions and answers before we wrap up. We've had some questions coming through. Please do feel free to kind of put any more questions that you've got through on the Q&A box, and we'll be happy to address those now. So just looking at the questions that come through. Okay, first one here. documenting a future plan for cash, are you able to bookmark it for a future use? If you then invest it elsewhere, to mitigate inflation risk in the short term, would HMRC consider this a legitimate use of cash for IHT trading purposes? Jerry, I don't know if you've got a view on that question there.
Yeah, sure, and it's a good question. And I think the answer is yes. That's the kind of thing that HMRC are looking for. So if you're saying that you've got a legitimate trading and commercial reason for wanting to invest in more stock to hedge against inflation risk or supply chain issues, then that's a perfectly legitimate use for that cash. And that could be something you either invest in now, or you say, well, actually, we've got a plan to increase our stock holding over the next 12, 18 months or whatever. But I think the important thing is that you then document that, and then that's then there in black and white, if you like, for you to show to HMRC should it be needed.
Thanks for that, Jerry. Got another question here. If you put spare cash into a holding company by way of a dividend, but you have a trading company need for the cash, how do you get the cash back into the trading company? So that's it's a good question, and it's one that does come up quite a lot, because in some ways, if you're shifting profits and spare cash up into the holding company, it can sometimes feel like, help, are we ever going to be able to get that cash back should the trading company need it? Well, the answer is that it's really quite simple. It's not a problem. If the trading company, for whatever reason, actually needs to use some of that cash again, that's not a problem. The holding company can quite easily loan that money back to the trading company, and that's not a problem at all. Don't know if you've got any other comments on that, Jerry.
No, I think you covered that. It's a pretty straightforward thing to lend money between companies within a group. So I think that's the point, is that don't hesitate to keep moving that surplus cash up into the holding company, because if you ever need it, some of it back again, it's a straightforward thing to lend it back should it be needed.
Okay, got another question here. You mentioned about holding companies having a number of uses. We talked about transferring spare profits and cash up to the holding company, but what else can a holding company be used for? Jerry, you got some thoughts on that?
Yeah, sure. I mean, I think we've probably talked about various things in other events in the past, but I think one of the big things that a holding company is useful for that you can't do with a standalone company is allowing you to divisionalize your company. So if you've got part of your trade that you want to hive off, either to run separately and report on separately, or even to hive off and sell, that's possible to do within a holding company structure, and quite straightforwardly. And in fact, you can, once your holding company structure has been in place for 12 months, you can actually sell off a subsidiary, hive off and sell a subsidiary like that tax-free from within the group. So that's just one example of things you can do with a holding company that you can't do with a standalone company.
Thanks, Jerry. That's good. There's another question come in here about debt levels. Reducing debt was one of the points in the LID formula. What's the right level of debt? Which is an interesting question, and it's kind of varies a little bit business to business. Every business is a little bit different, got different business model, different capital requirements, but there is the debt to equity ratio, which really applies to any business. And basically what the debt to equity ratio, quite simply, is just your total debt divided by your total equity in the business. And basically you wouldn't ever want that to be more than 1 to 1. So you wouldn't want to have more debt than you've got equity. in the business. So you really want to keep it below that in view of keeping the risk at a sensible level. And just to say on that, if you're calculating that, you want to make sure you're looking at your true equity situation. So not just the equity that shows on your statutory accounts that get filed to Companies House. That's not necessarily a true reflection of your real equity. Things like directors' loan accounts should really be treated as equity, and things like goodwill should be stripped out of assets, so that you're really looking at a true, real balance sheet equity. And you don't really want to be, shouldn't be more than 1-to-1 on your debt to equity ratio. Another question here before we wrap up. Just going back to the personal holding companies illustration that we showed, why do you need the middle holding company? Jerry, you got some thoughts on that one?
Yeah, no, it's a good question. I mean, I think the middle holding company is needed there. That's your kind of main holding company, if you like, where you're going to move your cash and assets up into. The personal companies are really there as an additional facility, if you like, to sort of supplement that. So if you've got some cash that the owners want to take out and invest in another route, that's there as a further option. But I think the default position should be that your cash is moved up and left in the main holding company. And also, if you're wanting to move assets within the group, then that would be between your main holding company and your trading company. So that wouldn't usually involve those personal companies. So that's just that's why we tend to suggest having both, or having your holding company as a first instance, and then if you want to add on those personal companies, that's something that can be done separately. If that's clear.
Good. Thanks for that, Jerry. Thanks for that answer. I think that's clear. Good. I think that's all the questions there. We had some really good questions there. Really good to have everyone on this morning's event. It's been great to host everyone. We look forward to speaking to everyone again soon. I would like to thank you all again very much for joining us. Thank you.